Hey everybody, welcome to the Modcast, episode number 7. 10 reasons we said no, a buyer's perspective on why it didn't work. Hey, my co-host Gary Roth. How you doing, Gary?
I'm great, Gordo. How are you?
I'm pretty fantastic. Yeah, it's I just got back from an amazing trip. I'm happy to talk to anybody about the country of Croatia and how I think you all should go and see the absolute natural beauty of the country. But we get into that later. Hey, for everybody listening, like it, share it. You know, if you do like what we talk about, like our podcast, download it, share it. You can get it on all your favorite podcast listening devices and platforms. And Gary, I always forget the name of it. What is it? Hit me. It's
Modcast.show.
Modcast.show. Is there a .com after that, or is it just Modcast.show?
No, I think it's just .show.
Anyway, Modcast.show. You can go on MWM.com. So modwm.com, modwm.com to see our website and to connect and engage with us, kind of meet some of the team. And Casey Harrison is the manager of partnership development. So if you want to talk to us about your firm or anything that's on your mind, connect with Casey, and we're happy to chat live with you. So as we're recording this, we just concluded the second quarter of 2025. It was quite a quarter. And I'm excited about today's topic, which is the 10 reasons we said no from a buyer's perspective. You know, we did 10 reasons why we said yes. This is 10 reasons we said no. And last time we got into it a little bit with number 1, which was cultural fit. And Gary and I talked about the dinner test. Gary, you want to remind them of the dinner test?
The dinner test is when you're meeting someone who could become a part of your organization, in whatever way. We were talking about, acquisitions, but is that a person who you would seek to sit next to at a dinner event, or is it someone that you would seek to avoid? And so the dinner test on the yes side is be happy to sit next to this person anytime. So I think we're going to get to the other side of the dinner test.
Yeah. What was funny is you and I received a comment from a listener just this morning on that very, dinner test comment. And it says, currently listening to the Modcast, you've unlocked a brand new core insecurity for me. The irrational fear that everyone's playing musical chairs just to not sit next to me at dinner. I thought that was very, very funny.
Very funny. And it was someone we know and someone who people would absolutely love to sit next to it at a dinner.
Absolutely. Delighted to sit next to this individual.
They have nothing to worry about.
They're very smart, very gifted. They're just a great human being. It's definitely somebody I would be looking to sit closer to, not farther away from.
For sure.
Yeah. But very funny that we got that. And as a listener, if there's a topic you want us to cover, if there's a subject you want to hear more about or what our opinions are, please just ping us. Let us know. We'd love to engage and hear from you. And by the way, I'm drinking from a great Modern Wealth mug this morning. If my little cup of tea here. If you'd ever like some of our swag or merch, if you ping us, we'll make sure we get something cool out to you as well.
By the way,
so that's that.
For the audience at home, we always record these in the morning. So this is coffee. I'm drinking coffee. You're drinking tea. I don't have one of my Modern Wealth mugs today. One of these days, maybe we'll record one towards the end of the day and we'll have something a little stronger in our cups.
Maybe something in a Modern Wealth liquid container of device of some sort, but with something different than coffee and tea. Yeah, maybe we'll do that when we're together later this month. All right, so that's cultural fit, right? Why we said no. So what does that mean? Beyond the dinner test, what does it mean when we say cultural fit and the reason for a no? And that's a question I get asked all the time when we're out talking to potential partners, even employees. And I was visiting an office yesterday, for example, with the team. And this was a big topic, cultural fit. And they kept saying, which I agreed with, by the way, you guys are just such a great cultural fit. I mean, just the way you think and the way you're processing information and the way you've built the firm and the things that you love and want to invest more into are the same things that we want to invest in. And when I think of cultural fit and I think of a no, it's not because you're bad. It's not because it's a bad person at all, right? It's not because it's you know, we're just not going to be friends. We can still be great friends at the end of it, but a cultural fit doesn't necessarily mean, or a no to cultural fit doesn't mean we can't be friends. So what does it mean to you when we say not a cultural fit?
Well, to me, again, this is very much is in the eye of the beholder, right? I mean, it's
Yeah.
very subjective, but it's really got more to do with, are they a good fit for the culture of our company, the things we're trying to do, the kind of people that we have, and um, every business is going to have its own culture. Um, I once saw like the definition of, when does culture develop, and the answer is like when you have more than one person in a place. And so it's it's you don't there's no perfect definition, there's no, like, set of bullet points, "You have to look out for this or else it's a bad cultural fit." There's that's it's totally up to you what that means.
Right.
And it doesn't mean to me, it doesn't mean like, "Oh, this is someone I'd wanna be friends with," necessarily. It doesn't mean that at all. I mean,
Right.
it's a professional context. Like, we don't have to agree on major issues. We don't have to agree on, you know, what sports we like or sports teams we like or what we like to do in our free time or anything. But it's more to do with how we approach things, how we treat people. In our case, we like to treat, I'd like to think we treat people well, but honestly and transparently. And so it's really just sort of whatever those set of sort of, I don't even want to say core values because then that sounds judgmental, but just, the things that make an organization be able to, move forward and frankly, even grapple with tough issues at times,
Mhm.
in a way where you can be honest and transparent with people and know that they'll take it in the way it's intended. And that's a very important thing for me in terms of cultural fit. So again, it's the
Yeah,
dinner
I think
test
it's like
isn't like,
operational style is what you're talking
yeah,
about right now,
exactly. Yeah,
you know?
exactly. So the dinner test isn't, "Oh, this is someone who I wanna hang out with on weekends," or it doesn't have to be.
Right.
If that's true, that's great, but that's not the goal. The goal is like, I can sit next to this person for an hour with a few other people, and we can have a perfectly comfortable conversation about whatever,
Yeah,
and
even difficult things,
even
we can
difficult
have that
things.
discussion and
Yeah,
it's not uncomfortable,
exactly.
right? So, culture's a big I think it's it when you see it type
Yes.
thing, right? It's in your gut.
Yes.
All right, the next one, the I've been accused of having a big one of these at times in my career, probably still today occasionally, ego. And, ego, it's very interesting. When we talk about ego here, a buyer's no, it's the we're super special. You don't understand our business. You don't understand our clients. Our clients think and do these things, and they're not going to accept a lot of things that will happen in an acquisition or in a merger or in a partnership. And because our clients are so unique and they're so special and so are we, right? And when we talk about ego in that sense, we've talked to I mean literally thousands of firms in our careers,
Yeah.
and we spoke to 300 firms in 2024 alone. We're on an incredible pace again this year. And when we're talking about ego in this sense, look, I hate to break it to everybody. I was an in-seat advisor for 16 years. I, with a partner, launched a firm and built a beautiful RIA and sold that RIA. And the name on the door doesn't matter. Your clients are not unique. I'm sorry. They're all people. They all have money with you. They all hope that you're managing the money well and that you're doing planning well. And it's ego is a big thing when we're talking to somebody. And again, there are they're people, they have money, we're managing the money, we're doing planning work, and they are willing to follow you. That's what you've been able to demonstrate, is that you can get clients and prospects to say yes to you. But beyond that, we're just not special. The industry is not that unique, and nobody has a big brand in this business. So it's, when you get stuck around a brand or a way of operating, that ego comes through. Do you have anything on ego?
Yeah, I mean, I think, particularly, in the advisory seat, like a lot of practitioners who are subject matter experts, you want to be confident. I mean, you do want like people who are confident and can sit with clients and prospects and project confidence. And I think so to me, it's the balance you're looking for is the confidence to know what you're good at and the humility to know what you're not good at and to not try to act like you're an expert at everything when you're not, because there's no need to.
Yeah. Yep. 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 All right. So that's 2, ego. 1, cultural fit. 2, ego. We're special and unique. 3, this one could be, this could be a long list of things, right? Unwilling to change. The way we say it internally is a willingness to change, or um, a willingness to give up control, because there are things that will change.
Yeah.
And one thing to be mindful of is you're joining another firm, right? You're receiving consideration for the change that's about to happen, right? That's what the money is for. And it's to pay you for your life's work and a really good business that you built. But with that will come some change. And so what are some options here when we say unwilling to change? What are some examples?
Well, I think the core thing, and again, we're coming from the position of, a buyer, a firm that's fully integrated, and we believe a lot of value comes from being fully integrated. So the people who choose to join us, they know that that's our model. The people who kind of just say, "Hey, listen, yeah, I want the benefits of a transaction that I want, but I don't want any of the benefits that you want." I mean, it's a willingness to change, but it's also a recognition that uh, an agreement is a two-way street. So I think that's the most important thing. Like, it's not just, hey, we're wiring you a bunch of cash at closing, so therefore we want you to do X, Y, and Z. We're not going to bring a firm on board or an advisor on board if we don't think they're good at what they're doing, right? It's how are we more valuable together? But we're showing a commitment by making a financial commitment up front, among many other things, and taking a lot of risk. And it doesn't work for a firm like ours if someone's like, well, tell you what, you pay me and I'll tell you what I'm going to do 100% of the time. The reality is 99.999% of the time, the advisors and their teams they're running their own day to day. And I think that's probably true for all of the integrated acquirers out there. So we have to trust, as those kind of responsible for the capital allocation of the company, that, the people who are in the seats are responsible and are going to do a good job. And that trust has to go both ways. So I'd say it's almost more of like it's a two-way street.
A couple of examples of unwilling to change, right? A lot of firms, like ours, we have an investment management team, and we're going to want our team to be involved in the asset management pieces of your firm, not allocating the capital, but we want you to be on our menu, and we want you to use Tuck, our head of investments, and his team. That's an example. Unwilling to change the name on the door. Unwilling to change. Maybe there's an evolved way to do some complex financial planning, and I've said it before. Like, Excel is not a financial planning suite. But there are a lot of advisors that have built these beautiful, elaborate Excel spreadsheets, and that's how they do financial planning. It's just not
Right.
scalable.
Right.
And having an unwillingness to change away from legacy systems is a red flag for a firm like ours. So those are examples that are kind of more tangible, less squishy, if you will.
Yeah.
All right. So that's number 3. Number 4, investment management philosophy. This one I love. We were again. I was doing a visit yesterday, and that team, they manage money in a very similar way to the way Tuck thinks about investing capital and deploying capital for clients. And we're aligned. Investment management philosophy is completely aligned. But when we find a deal, a team where maybe they ran to cash a few years ago because they were worried about an election, or they were worried about the national debt, or they were worried about some event that may unfold in our life, that could be detrimental to the client portfolio. So they ran to cash, and then they have no ability to get back in, and they haven't gotten back in, and they've missed this 50% move in the markets in a couple of cases that we've seen. Like, that's a problem. That's not our philosophy. Our philosophy is you remain invested and you make allocation changes as information comes in, but we never go 100% equities or 100% cash based on mood swings. And so having a common investment management philosophy is super important. You have anything on that?
Yeah, I mean, well, I think you said it all, and I think again, what that is totally dependent upon the firm you're joining. And again, there are
Yeah.
people out there who are like, no, 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 it's all completely 100% decentralized. You do it on your own. And then there are people who, you know, take the approach that we're taking, and then there's some people where it's probably even more centralized. So, but again, it's just I think that's one of those things where if you're looking to join a firm, that's where you want to make sure that your interests and your style matches the firm that you're joining.
Yeah, that's right. Yeah, you should have, all of these things are points of alignment, by the
Yeah.
way, that we're talking about: cultural fit and ego and willingness to change, investment management philosophy. All of these things are points of alignment. And the more points of alignment you have, the better your future partnership will be. So investment management is a big one. All right, I'm going to let you take number 5. This is something that some advisors don't realize the impact that this has on the value of their firm and their future. And it's marks on your ADV/U4. What is that? Take us through that.
Yeah, this is your compliance history. So obviously this is a regulated business, and one of the things, probably one of the first things any firm is going to do is look at the compliance record of someone who's joining them. And this is another one of those things where it's like, well, that doesn't mean necessarily that if you have some disclosures, that you're automatically, persona non grata. You're not, probably, because you're still in the business. So, I mean, there may be things that were in the past that were resolved, or, whatever, misunderstandings, or, but it's certainly, those are going to be certainly scrutinized and looked at. And I think a good firm would really need to understand what what the circumstances were if there are marks on your U4. And so it's just something, I mean, if you're it's another one of those things about sort of approaching, a transaction with an understanding of like what's expected of you as a joiner or seller. Like, you should be aware of what your own history is if you haven't looked at it in a while, and be prepared to discuss it.
Right, right, right. And it can't just be, oh, that client was crazy. Oh, and
Yeah.
so was that one. And then there was a third one that was crazy too, right? Like,
And
that,
this is one of those things I'd add, like, if you join a firm and you're taking any equity from the firm, a firm like us, or, name any of the firms out there that you read about, when that company goes to create any kind of liquidity, any kind of transaction that you as a shareholder will benefit from or be able to sell equity in, that company is going to have to answer for just about everything it ever did, explain everything it ever did, There was a movie many years ago called Defending Your Life, which I don't really remember exactly what it was about, but the title was, I think it was sort of like having to argue, like getting to heaven and having to like argue, like literally defend your life, like everything you
My
ever
gosh.
did.
Yeah.
And so that's going to happen for the company you're joining. So it won't be maybe
Yeah.
that detailed, but yeah, you have to be ready to discuss it, and you should be aware of your own history for sure.
Yeah. And it's important. It's important to the acquiring firm or your partner that they just understand it
Yeah.
and get comfortable with it.
And there will be things, I mean, there are certain people who will not be able to join certain firms, you
Yeah.
know? So,
Yeah. It's not that you can't sell the business. It's just the pool of buyers will be smaller. That's all.
yeah.
All right. Number subs 5 marks on your U4/ADV. Number 6, sustainability and transferability of the business. Okay. So let me give you an example. You have a $300 million book of business. Your typical client is the mom and pop millionaire next door. Okay. That's who your target market is. You have $1 million average relationships. But 2 of the clients have $75 million each under your advisement, right? So literally half of your business is tied up in 2 clients. And half of the business is the quote unquote average millionaire next door. Let's just strip the averages out, take the 150 million out that is these 2 clients. And let's just say the rest of them are millionaire next door clients. Well, those 2 clients are a big part of your business, 50% of your AUM, right? Is that sustainable? What are they buying from you? What is the reason for them to do business with you? And how is that service being delivered? Are they going to stick around? If one of them fires you, I mean that's 25% of your business if one of them terminates you. If the second one terminates you, it's half of your business, right? And so how sustainable is that client relationship? These are just examples. And then how transferable is it? Are these people your best friends and you plan to retire in 2, 3, 4 years, but you're trying to maximize and monetize these relationships in your deal? Like, these are examples. Do you have any other kind of off the cuff examples? We didn't talk about any of this list, by the way. This is all just us
No.
going at it.
Yeah, I mean, I'd say, something the way I like to think about it is you're a financial advisor, which means you've also probably been an investment advisor, or within your financial advice you're giving, you're making investment recommendations. Would you invest in the equity of your own business if you were independent? Would you look at your business and say, this is a stock I would buy versus one down the street that has different characteristics, and just, give it an honest appraisal of how attractive an investment it is, or at what price. And, um, I think, again, that's hard to do. It's hard to look in the mirror and see all the things people see when they look at you. But if you are in the market and you're not getting the results you want, then you might want to evaluate that and make some changes accordingly.
Yeah, so, like, if the top 10 clients in your book of business have, I mean, just a massive portion of your revenue and AUM, that unless you only have 10 clients, then, it's a problem, right? You
It's
want
concentration risk. Yeah.
yeah, it's concentration risk. We wanna, again, that example, those 2 $75 million clients.
Right.
That's not your typical core client. Your typical core client, if you look at the rest of the business, is the millionaire next door. You've
Right.
demonstrated you can attract them and service them and take care of them.
And by the way, we've seen it multiple times in practices that had one or two big clients, or maybe they were mostly individual, but they had some institutional business, and you lose that one high revenue or high fee client. It's not about, I mean, the AUM is window dressing in a lot of ways, but it can be, if you were on your own, destabilizing. I mean, if
Yeah.
you have one client who is 10% of your revenue and they leave you, you know, if you're at a 50% margin, it's 20% of your profit, right? And like now all of a sudden it's like, I can't afford to pay myself as much, or I can't afford to pay my people.
Or do that
And
marketing program,
yeah,
or do,
right. And so
right.
a stronger business is one that does, of course you're going to have a range, but a stronger business is one where you don't have that risk of like, I lose one client or two clients and all of a sudden I have a completely different financial profile.
Yeah, a buyer is looking for a durable business, right? One that can sustain a couple of clients leaving, the market gets bumpy, but the core clientele will be there with you. It's a similar demographic. Most of your clients are about the same size, about the same age,
Yeah.
kind of about the same type of thing. They're not all, all clients are custom and unique. Don't get me wrong, but if
Right.
you have some outliers, that becomes something that you're going to have to, just be transparent about and defend.
Yeah. So that's the client risk. The other side of it is the key person dependency, or
Mhm.
how critical are you? And this is the transferability issue. Um, and the sustainability issue. It's both. Basically, the more important you are to the business, the less valuable the business is long term to a buyer, unless there's a clear path. And this is why people talk about succession planning and they talk about G2 or G3. But if you're do all, be all, end all the clients are only there because of you. And if you got hit by a bus, they'd all be at risk. Then your business should be worth a lot less than a business where the key person or people have transferred a lot of the relationships, or have a team-based approach, or have what is kind of not artfully called institutionalize the relationships. And that's why big companies, like they have big brands, and they have big brands because it's like, well, if someone leaves or someone gets hit by a bus, it's still the name on the door is,
Yeah.
the company name, not, a person's name. And if they're people's names, they're people who are probably aren't alive anymore. Like I assume Merrill and Lynch are no longer alive.
If they are, we need to, we both read a book recently that we should probably talk about in a future episode. Uh, and maybe they read that book and they were able to extend life beyond many, many decades more than anybody else. But
Yeah.
yeah, they're probably long gone.
Yeah. I'm pretty sure JP Morgan is long gone.
Yeah. 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 All right. So that's, do you have a sustainable and transferable business? The next one is client demographics. This is a big topic. We could do a whole episode just on client demographics. As we're looking at businesses, we're looking at, what does the client base look like? Um, do you have kind of all the decades of ages covered? Are
Yeah.
they lumpy in one particular decade? How much money do they have under management by decade of age? What's your fee rate by decade of age? So we're trying to, again, just, I said it earlier, durable business, one that's going to be lasting and going for a long time. And the more durable your business is, the more sellable it is, the more transferable it is.
Yeah.
And that includes client demographics, right? You don't want to be overly concentrated on one particular decade of age over another. And you want to have kind of a nice curve to the age of your clients
Well,
and
and
what you're
that
doing for them.
and this actually goes back to episode 2, I think it was, when we talked about the dirty little secrets of organic growth, and
Yeah.
um 2 or 3, and we talked about the treadmill effect, and the rate of distributions and withdrawals out of the business. And of course, it's just a fact that the older your client base is, the higher percentage of your clients that are in retirement, the more your assets are declining every year systematically. And that's okay. But you need to replace them somehow, or you're just going to have a declining business.
Well, they'll
So,
be your wealthier clients if you look at
yeah,
how much money you're managing by decade of age.
yeah,
The later you get in life, the more money you have.
yeah.
So that's the positive
That's
of it,
natural.
right?
But
Yeah.
if it's all going this way, then you're gonna have a trend line that's challenging. And it goes
Yeah.
back to that whole like, would you buy that stock?
Right. And if you can, and if you do have a book of business that has a more mature client demographic, figuring out how to work with the next generation
Mhm.
in their family, that could unlock value in your business as well.
Yeah.
Like if you can really demonstrate that you're working with the people who this big wall of wealth transfer that everybody talks about, this tsunami of wealth transfer that's coming. If you can figure out how to make sure that it stays with your book of business that's desired by a buyer. All right, so that's client demographics. That's number 7. All right, we got 3 to go on the top 10 reasons, or 10 reasons I should say, that a buyer might say no. And number 1 was cultural fit, 2 was ego, 3 is unwilling to change, 4 investment management philosophy, just conflict there. 5 marks on your U4/ADV, what's your compliance background like? 6 we just did, or we recently did, sustainability and transferability of your business. 7 client demographics. 8 Gary, staffing, quality and quantity.
Yeah, I like the way this was written, quality and quantity, because well, one of them is it could go either way. Quality, of course, is just one way. You want a high quality team, and the more, and again, quality is also subjective. But let's just agree that people can agree on like, oh, this is a good team, or this is a weak team. And when you built a good team, it not only means it sort of checks a lot of those other boxes we've already talked about. It makes the business more sustainable and transferable. It makes everything sort of stronger in terms of the ability to continue to operate and thrive in new environments. And it also shows um, qualities about the leader or leaders, that they brought in people who were good. And sometimes that means people who, challenge them and make it clear that they don't know everything. So it goes back to ego and willingness to share control and all of those things. So it really is incredibly important. The quality, the better the team, the better the business. Quantity probably goes both ways. You don't want to be understaffed and you don't want to be
Mhm.
overstaffed. And again, you sort of have to look at your own business and say, yeah, is it right sized or not? If it's understaffed, then you've got challenges coming in the door. And it's like, well, you've either had false economies and been kind of starving the business, which probably means like you've just been not trying to grow, or you've been overworking a small group of people and now they're gonna be
Yep.
exhausted. Maybe they're also being underpaid. But same thing in the other direction, overstaffed. It's like, okay, well, how do we make this work? How do we make sure people have work to do? you know? And so again, everyone's gonna have a different point of view on this. But I think broadly speaking, most firms are gonna say, okay, we're gonna we really want to get a sense of the quality and quantity of the team, and is it the right fit? And if not, it's probably best addressed before doing a deal.
Right. And don't tell somebody your team has capacity to serve more clients, and then 6 months in to your new partnership, you've brought on 5 new clients and go, "The team is completely
Yeah.
worked and stressed, and they have no capacity," and like,
Mhm.
well, then you just weren't honest about the staff's ability, and the capacity available to them. And you talked about quality, we talked about quantity, and one thing you touched on that I wanna just kinda come back to, and that is appropriate comp for the work that that person is doing
Yeah,
is super important, right?
absolutely.
If you haven't given them raises in a year or 2, and now you've joined a new partner firm, um, are they gonna come hat in hand and say, "Hey, boss, you haven't given me a raise in a year or 2. You just had me go join this new firm. When am I going to get that raise?" Like they've got to come in at an appropriate comp levels and benefit package.
Yeah,
So
and an intelligent buyer is going to know that and is going to evaluate that and is probably going to price it in, just like back to the old real estate analogies we like to use.
Yeah.
If your house hasn't, had a fresh coat of paint in 20 years and the roof is leaking and all that stuff, like that's going to get built into to the price that someone's willing to pay.
Just gets added to the bid.
Yeah, deferred maintenance.
Yeah. All right. We talked about this one actually.
Yeah.
I didn't read ahead.
We were so excited. We actually talked about the last two.
We did.
Yeah.
So we should probably just at least let them know what number 9 and 10
No,
are.
it's number 9. Number 9.
And again, we created these lists, and then we do no scripting other than just the bullet points of what the list is. We should probably show you in the show notes at some point.
Right.
But so number 9 is too many big fish, client concentration risk. And again, I'm the bozo that didn't read ahead. So
we talked about
I think
that
we
one.
covered this one.
Yep. Yeah. And by the way, somewhere we should have like was it the Allen Iverson practice quote? We're talking about practice. So we don't practice. Not this. We were too busy running a company. That's the thing.
Right.
This is like
we just showed up on the first tee and hoped to hit it down the middle of the fairway.
Yeah.
And the good news is we hit it. The bad news is we can't find it.
Right.
So,
yeah, exactly. And we might hit our
number 10 is systems and tech stack. Again, Excel is not a financial planning tool.
Yeah, I've heard that somewhere recently.
Yeah, but it's beyond that, right? Like if you my portfolio accounting system is really great. It does really good performance reporting and billing, and I can't live without it. Well, in today's world, these portfolio accounting systems are definitely portable. You're going to get all your clients' past performance reports as long as you're using one of the majors. Like if you're using your own thing, that's a different story. But it's different today than it was even 10 years ago.
And listen, as much as you love your own tech stack, you don't want disruption. Most buyers are going to take that into account. And some, like for us, like we use multiple financial planning software tools. But
all the majors.
But there are some things that you really want to have one of and not 27 or 35. So if you're a seller and the firm you're joining isn't asking you to integrate, they will probably at some later date. And so that might be fine. That might be preferable to do it at some later date. But if they don't ask you to integrate, then maybe you don't want their stock.
Yeah, maybe that's a red flag for you. So, because how do you drive an efficient, growing business if everybody's kind of on their own legacy systems doing their own thing?
Exactly.
All right, I'm Gordo. That's Gary. This was episode number 7 of the Modcast. 10 reasons we said no. 10, systems and tech. 9, too many big fish, client concentration risk. 8, staffing. 7, client demographics. 6, sustainability and transferability. 5, marks on your ADV and U4. 4, investment management philosophy. 3, unwilling to change. 2, ego. And number 1, cultural fit. I hope you enjoyed the show. Next time, let's see, what are we talking about next? We're going to talk about how private equity is powering the RIA M&A space and why it's good for you. We definitely are big believers in it. When used appropriately, we're going to have a whole bunch of stuff to talk about there. And this has been episode number 7. Gary, any final wrap?
I think that'll be a fun one. And everyone, please, whatever you're supposed to do, like, subscribe, go to modcast.show, send us questions, episodes, themes you'd like us to explore. We're open to suggestions.
And if you want some swag, just ping us and we'll get something out to you.
Maybe. Depends.
Yeah, we'll do it. Yeah, we got some cool stuff. All right. Thanks, everybody. Have a good day. Sorry, there's like a hair or something on my microphone that keeps tickling me. So if you saw me playing with that, that's what I was.
I hope that's only in the outtake.
I've hoped to free it up.